As the Fed continues to tease us with a rate hike, what factors are constraining Janet Yellen from pulling the trigger? Here with insight, market analyst Joseph Smallman. Now, an increase, we know, is imminent. Joe, how prepared is the commercial real estate sector?
We're waiting. Please do it. Pull the trigger. I mean, the market knows it's going to happen. Everybody's expecting it. It just keeps getting delayed and delayed. Something's always going to pop up in the world, but we are ready for it. We're expecting it. I wish they would just do it, get it over with, and let us just move on.
Now, volatility in emerging market economies in China in particular were cited as reasons Yellen didn't increase the rate back in September. But, I mean, to say the least, this is an overdue move.
I think it's time to start tapping the brakes. Obviously, she has access to data that the rest of us do not have, but what we can see within the public markets, it just feels like it's time to make a small move. It's not going to make or break us. We know we need to start slowly tapping the brakes on the economy. Things are really going good here. There can be some parts that are overheated, but it is a nice steady growth. I can understand her concern that she doesn't want to derail that growth. And with what's happening with emerging markets, with ISIS, all the other elements that happen almost once, every week, seems like something. I think it's just time to bite the bullet, do the move, and let us move forward.
Now, talk to me about the prospect of the commercial real estate market outperforming the U.S. economy once the rate hike happens.
Well, there are many sectors within the commercial real estate market. There's not really many places you can go to get a nice return on your money now without some risk. Obviously, the bond market, if everybody's expecting rates to go up, the bonds will be going down. Equity markets are, still frothy, running back up again, but we've seen a lot of volatility this year. The real estate markets have done very well also. I know there's some concerns about the multifamily. We're up 33% since '07. That's a nice rise, but there's a reason for that. Rates are going up too. The baby boomers are moving into apartments, downsizing. The millennials are wanting to have more mobility. We're seeing jobs much more mobile. It's really not that American dream to own a home as much. We've gone, I think, from 69% down to 63% occupancy. We're moving more like a German mindset where we're moving towards more of a rental versus an owner's community. One thing that a lot of people are not speaking to is the impact of Airbnb. I was very impressed. Last time I saw you in London, I used Airbnb, and the couple that rented me the flat there in West London said that they were hairdressers. And as a matter of fact, they shut down their business, and all they're doing is renting flats via Airbnb and making more money in a month than they made in a year of running their own business.
I mean, we're still looking at private investors that are propping up the biggest waves, no?
Yes. I mean, the bulk of our buyers are not the institutionals. They're the smaller family offices, the people who are high net worth, maybe some syndicates. Obviously, we do still deal with REITs and those, but we do see more and more people coming into the market, maybe first-time buyers, and especially international buyers coming in, because the U.S. property prices are still generating very good yields, stable currency, and also stable markets. So Airbnb is not driving the market. It's just another new dimension that we've never seen in this market before. The sharing economy is something that's really just come to realization with technology over the past 3, 4, or 5 years.